Good afternoon, everyone, and welcome to Nova 401k Associates webinar, What the 2020 Election Means for Retirement Policy. This will be presented today by Craig Hoffman. Craig is an attorney and senior consultant with Nova 401k Associates. He has over 35 years to focus exclusively on federal tax and ERISA matters relating to the design, implementation, and operation of tax-qualified retirement plans. Today's webinar is eligible for CFP, ASPA, and IRPA CE. There will be a survey that pops up immediately after the webinar closes, so please be on the lookout for that. You do need to complete the survey in order to receive a certificate. There is some information specifically for CFP and IRPA. We do have to have that information in order to provide you a certificate. If you have any questions throughout the presentation, please type them in the questions box. We're going to try to answer a couple throughout the presentation, but if we're not able to get to your question today, we have a lot of material to cover. We will follow up with you with an email. Craig, we are ready to go.
Thank you very much, Andrea. Hello, everybody. Yes, that's me. I'm happy. I know I saw some familiar names on the registration list. I'm very happy to have come out of retirement to work with Nova. For those who don't know me, as you can see, I've been around a little bit, but I spent 10 years as a lobbyist working for the American Retirement Association, and before that was involved with the American Retirement Association and their Government Affairs Committee. So I say that only because I have great interest in the subject matter we are about to cover today. It's always interesting when we have an election and what that will mean for policy, and in our case, focus on retirement policy. And so there is a lot to consider, and there are going to be some interesting developments in the months ahead. So here's our agenda. We have more stuff than we can cover. I always like to put in a little more than I'll probably cover under the theory that if we don't get to it, at least you have the slides to take a look at. We're going to try and focus on the election, what that means for regulatory policy, what the Biden administration might put forth legislatively from a retirement policy perspective. And then we'll focus on the most likely vehicle for retirement reform in the upcoming Congress. The Securing a Strong Retirement Act of 2020 was introduced in the last Congress. That Congress adjourned without considering it, so it will have to be reintroduced, that is likely to happen sooner rather than later. And it's a bipartisan bill, and it certainly has a very good chance of moving forward. We'll talk more detail about that when we get there. So we had an election. Anybody, if you've been under a rock for the last year, maybe you missed it, but we had an election. Joe Biden will be our next president. Kamala Harris, our next vice president. The Congress is an important element in how we look at retirement policy, and that turned out to be very interesting. There was an expectation that the Democrats would have a wave, didn't quite turn out that way. The House of Representatives remains in Democratic control, but rather than gaining seats, some seats were lost, such that the prior margin of 21 votes has now been reduced to either 13 or 10, or 9, excuse me. It'd be 11 or 9. I'll get there eventually. No, 13 or 9. In any case, the bottom line is going to be a very razor-thin margin in the House. In the Senate, it's even more razor-thin. The Democrats, with the results of the Georgia election, now have 50 seats. The Republicans have 50 seats. That's a tie, but ties in the Senate are broken by the president of the Senate, the vice president, who is Kamala Harris, and so it effectively gives the Democrats control of both houses of Congress and the White House. With that said, the razor-thin majority held by the Democrats, certainly in the Senate and not much more in the House, allows, the important point for the Democrats is they now control the agenda in both houses of Congress. They both at a leadership perspective, but also at a committee perspective. The various committees of Congress, the chairs of those committees represent the controlling party of their respective House of Congress, and so there will be Democratic chairs of committees, of all the committees in both the House and the Senate. And the House has already been under Democratic control, and for our purposes, a very important voice in Democratic leadership, the chair of the House Ways and Means Committee, Richie Neal, was reelected and and he had to fight a hard primary battle, but he's somewhat of a centrist, and he is now he will continue as chair of the House Ways and Means Committee. Why is that important? Because Richie Neal has had and continues to have great interest in retirement policy. And in fact, he put out just this week an agenda, the Democratic agenda for the House Ways and Means Committee, and it has a number of items that he has been putting forth, including the Automatic Retirement Plan Act that we will briefly touch on as if we have time at the end of the session of the webinar. So in any case, they will control. Ron Wyden will now become the Democratic chair of the Senate Finance Committee, and he too has shown great interest in retirement policy. He worked with Chuck Grassley, and before that, Orrin Hatch as Republicans to put forth bipartisan retirement legislation, and that's the key. Retirement policy reform legislation has traditionally been done on a bipartisan basis for the last 20 years. There's been very little you'd have to go back to the TEFRA, to be honest, the 82 bill. I know I'm showing my age. In any case, so they control the agenda, but because of the razor-thin majorities, the centrists within each party will likely have a great deal more leverage than ever before because their votes can swing a bill either way. And so, despite the fact that the Democrats have both houses of Congress and the White House, it's going to be difficult to move along something that's to the left, way left of center. Let me put it that way. There will certainly be efforts to put forth very progressive bills, but the chances of them passing this Congress as it is probably not all that good. But with that said, the point to be made that there is one vehicle through which a majority party, even with a razor-thin majority, can push something through, and that is the budget process. As we have in the pension area come to see, many of the pension reform bills get attached to a massive consolidated omnibus budget act and Reconciliation and Budget Act, COBRA, Budget and Reconciliation Act. And that's what we will likely see. Why? Because a COBRA bill is subject to special rules in how the Senate processes that legislation. The degree of debate is limited. You can't filibuster it. It has to be put forward, and all it takes is a simple majority to pass. And so expect that will be the vehicle through which the initial policy matters of the Biden administration are put forth. That is where you may see some tax changes, albeit not as radical as some might suggest, but there will be I mean, one likelihood is the corporate tax rate's going to go up, not to where it was 37%, but something higher than where it is right now. And so it's going to be an interesting time for legislation, and that segues me back to retirement legislation. This Congress, any Congress, wants to be perceived as being able to get something done. And obviously that's been difficult for certainly the last Congress to get anything done. They did secure, and you know, they passed that on a margin of 417 to 3 in the House of Representatives in May of 2019. It does not get more bipartisan than that. And so the chances of this moving through with the opportunity, particularly with the events of the last week, I think there will be an effort to try and find a way, when possible, to reach across the aisle. And so I think pension reform, from what I am hearing, is likely to be considered very early in this session of Congress, which is just beginning. I'm not sure the Senate itself hasn't yet come into session, I don't believe. And so it's got a lot of attention. It is a House bill, and it's likely to be married up with similar legislation coming out of the Senate. As I mentioned, Senator Wyden has co-sponsored with the ranking member of the other party when he was chair, bipartisan legislation. And some of what's insecure actually came from standalone legislation Ron Wyden has introduced in the past. So it's something to look forward to. All right, let's move on. Regulatory policy. We do know that the Biden administration will, as chief of the executive branch, the President Biden will control the policy agenda for every federal agency. So expect this is the tradition of all incoming presidents where that are not being reelected, and that is to literally on Inauguration Day, usually coincident with the swearing-in ceremony, his chief of staff will be sending out a memo to every single federal agency telling them to stop what you're doing right now till we get a Biden appointee in there to look over your shoulder to make sure it's in accordance with the president's policy objectives. And so the memo will say, if you haven't sent any reg to the Federal Register yet, stop. If you've already sent a reg to the Federal Register for publication and finalization, but it hasn't been published yet, pull it, withdraw it. And even if a reg's come out already but has not yet become effective on Inauguration Day, consider issuing some temporary regulations to postpone the effective date so that we, the Biden administration, can give it due consideration and consider whether we might want to make some changes to that. That, as you might recall, is what happened with the Obama administration DOL fiduciary regulation, which the moment they came into office, they issued regs to extend the effective date by 60 days, I think it was. And then they extended it further, and eventually that reg got killed in the courts, as much because the Trump administration did not make an effort to really defend the regulation. They didn't appeal it to the Supreme Court when they lost at the Fifth Circuit. So there are many ways to kill a reg, and let's talk about then what regs may or may not be subject to this memo from the Chief of Staff. The DOL regs on electronic disclosure became effective July 27th. I bring them up because there are some from the Democratic Party who have had great concerns about how far, in their opinion, the DOL went. In any case, that reg is final and effective July 27, too late. How about the DOL has been well aware of the potential that there may be a new administration. So there have been some midnight hour, if you will, regs issued over the last few months that clearly contemplated the need to get these out and effective before Inauguration Day. So we had the regs on the use of non-pecuniary factors. These are in selecting plan investments. That's a no-no. You should not use non-pecuniary factors. These regs were more commonly known as the ESG regs, environment, social governance regs. In any case, they were issued November 13th. They're effective January 12th before Inauguration Day. There may be bills in Congress to revisit. In fact, there already have been bills filed in Congress that would overturn this regulation by law, which Congress can do. So that's done, as is the proxy voting reg, in which the DOL basically said plan fiduciaries shouldn't spend money on how to vote proxies unless it essentially affects pecuniary factors with regard to the investment in that particular company. Again, that came out December 16th and is effective January 15th. Now, notice the ESG reg had a 60-day effective date. Why? Because it was found by OMB to have significant economic effect. Therefore, it had to have at least a 60-day window. Still got it in. The proxy voting, OMB found did not have that economic significance, and so it had only a 30-day. In fact, isn't today the 15th? No, it becomes effective tomorrow. So I know you're on the edge of your seat. In any case, those two regs, even though they're effective, may be challenged under the Administrative Procedures Act as not having followed proper protocols and getting comments and rushing to judgment, so to speak. That's one way these regulations may be challenged next year. And again, if the Biden administration chooses, they may not actively defend the regulations, and that's another way for them to die. A somewhat controversial regulation is a class exemption, prohibited transaction class exemption, that was released in conjunction with the reinstitution, if you will, if it was ever gone, of the 5-part test for whether investment advice is a fiduciary act. This has been very contentious. It was published December 18th. It is economically significant. It becomes effective February 16th. After Inauguration Day, it will be frozen. Patty Murray, the incoming chair of the Senate Health Committee, as well as Bobby Scott, the continuing chair of the House Education and Labor Committee, have both already urged the Biden administration to withdraw that reg. On top of that, when there were comments solicited on the reg, a number of senators joined in a letter criticizing the reg. One of the signatories to that letter was Kamala Harris in her role then as Senator of California. So that one will be frozen. Lifetime income, those regs have not been issued in final form. They're pretty bipartisan. They'll be frozen. Everything's going to be frozen for a while, even stuff that's non-controversial. So it may be a little longer till we get this actually in final form, but I don't see it as being a particularly partisan issue. There's one other way that the new administration, or in this case, the new Congress, together can act to undo regulations issued at the 11th hour of the Trump administration. And it comes in the form of the Congressional Review Act. Under this law, which was passed in the 90s, Congress has the ability to nullify any regulation that a federal agency issues if it passes a resolution of disapproval. The resolution of disapproval must be passed by both houses of Congress and then signed into law by the president. If the president doesn't sign it, then both houses of Congress would have to overcome his veto by a 2/3 margin. because of that, this rarely comes into play except in circumstances such as we have this year, i.e., where we have a new president of a different party and both houses of Congress aligned with that new president's party. That gives them the power to undo the things that were done in the last minute of the old presidency under the policy directives of that party and that president. So what regs, well, I forgot, there is a time limit. The Congress can't reach back forever. The deadline is 60 legislative days after it receives a copy of the regulation from the Federal Register. With that said, a special extension applies for rules pending when a session of Congress adjourns. They get a reset of the 60-day clock, if you will. The reset is that when the new Congress is seated, 15 legislative days later, we start a whole new 60-day window. And there are two things to point out. One, we are in that provision, that position. The 116th Congress adjourned in December. The new Congress is the 117th. And so that reset of the clock occurs. In addition, this is not calendar days, but legislative days, days when Congress was in session. And so it appears what I've seen the experts say that 60-day look-back period began on August 13th. And so regs such as the ESG, non-pecuniary factor regs, the proxy voting regs, and the class exemption on concerning investment advice are well within the CRA. With that said, whether the Democratic Congress wants to use that power remains to be seen. The Republicans used it a number of times, far more than ever before when the Trump administration replaced the Biden administration. There is some thinking that perhaps the Congress, if you nullify a reg through the CRA, then the agency is precluded from regulating in that area until Congress acts in that area. And there's some concern that maybe tying the hands of the Biden administration to await legislation from Congress might not be the best thing to do. With that said, there's a coalition of various progressive organizations called the Coalition for Sensible Safeguards, who have already put together a list of 40 different regs through all federal agencies that they believe should be nullified under the CRA. So we'll see where that goes. Moving on, we also have a Biden administration who will be issuing regs. What will we see? Well, the pooled employer plan rules, or the pooled employer plans became available January 1st of this year, 2 weeks ago. And with that said, the only regs we have out right now on how to operate these are those merely to register with DOL. There is substantial guidance needed on the operations and responsibilities of pooled employer providers, principally from DOL, but also from IRS. So that's one area that needs to be addressed. Unfortunately, I suspect it may be delayed simply because of the change in administration. The operations of pool plan providers is probably not that partisan, but clearly a Biden administration may have a different flavor than if the Trump administration were writing those regs. Similarly, I skipped over the first bullet. The prior administration put out in late fall or early fall a request for information on whether a prohibited transaction class exemption is needed so that pooled plan providers can offer investments that might present a conflict of interest to the participating employers in the pooled employer plan. That's a lot of alliteration there. Richie Neal, who, as I said, is chair and was chair of the Ways and Means Committee, wrote a comment letter saying, "Hey, DOL, I wrote the law." And we thought about possibly, we considered having an exemption, a prohibited transaction class exemption. We considered it. We purposefully chose not to do it. Don't do that. So that doesn't mean they won't do that, but it means it will certainly be a tighter exemption with more protections probably than may have otherwise been the case. The DOL will probably revisit investment advice fiduciary. A new DOL may also want to take a look at the e-disclosure regs and otherwise potentially make some changes there. Moving on. What would our soon-to-be new President Biden potentially look to from a legislative policy, a bigger picture perspective, if you will, of his agenda? Well, surprising as it may be, retirement policy was not a hot topic on the campaign trail this past fall. But with that said, we have an idea of where President-elect Biden may be going thanks to a page or a pamphlet, a white paper on his campaign website that he has titled "The Biden Plan for Older Americans." And it's got a number of different things in it to strengthen Social Security, look at the strengthen multi-employer pension plans, but I think for many of us, two things I would focus on that could significantly impact the world of retirement plans today. What are they? One is this idea that every employer in America should have a payroll deduction type workplace savings arrangement. And this is not something new. It's been something that has been previously in Obama-Biden administration policy proposals put forth in conjunction with their budget report, their proposed budget every year that an administration does. So this has been out there, and the Biden plan would likely look to that. But it's pretty sketchy, frankly, what's in the on the white paper, if you will. What I think more likely to be the instrument of affecting this policy is the Automatic Retirement Plan Act that is sponsored by Congressman Neal, who I've already alluded to is chair of the Ways and Means. And there are a number of slides toward the end of the deck. We may have time to talk a little bit about that, but to give you a flavor, Richie Neal has put forth in prior Congresses the same proposal, a federal mandate. There has, over time, it's begun to gain more acceptance. After Obamacare, there was a real reluctance in the Republican side of Congress to enact any kind of mandate again. And this is what this idea has, as the other side arguing, well, what's wrong with requiring everybody to have a workplace savings arrangement? And the response is, well, we shouldn't make a mandate. We should find ways to incentivize private employers to have plans. And you've seen this play out with various states in invoking state law to require this type of program. This would be a federal program a federal mandate in all 50 states. And so the Obama-Biden administration was supportive of those state efforts, and I think the Biden administration will still be supportive. But a better result would be, a federal mandate on all 50 states. So Richie Neal, as I mentioned, put out his agenda, Democratic agenda, and he lists the Automatic Retirement Act as one of the things he wants to get done. And so that's where I think that would go. The second proposal is a restructuring of the tax incentives associated with retirement plans. radically restructure them. Excuse me. For years, this is nothing new, many of progressive voices have voiced criticism of our current retirement tax incentives as unfairly benefiting the wealthy at the expense of low-income American workers. And the basis of their argument boils down to the effect of our progressive marginal tax rate system that applies to taxes, and that the fact of the retirement incentive is largely couched as a deduction or exclusion from income, and thereby leveraging the marginal tax rate as the function of savings. And so under current law, if you make an elective deferral to a 401k plan, it's not included in your income. If you make a contribution to an IRA, it's deducted from your income. If your employer makes a matching contribution to your plan, it's not included in your income, not immediately. The tax is deferred. And so at some point down the road, when you withdraw that, you will have to pay income taxes on it. But the upfront incentive and tax savings is much greater for those in higher marginal tax brackets. For example, take a single taxpayer making $600,000 who makes a $10,000 401k contribution. That person would save $3,700 in taxes, 37% of his or her contribution. On the other hand, if you are making $60,000 and you make that same $10,000 contribution, you only get a $2,200 tax savings because you are in a 22% tax bracket. And the theory or the argument goes, this is unfair. It's giving an unfair advantage to the wealthy that would save, even without this incentive, the people where there is a savings gap who need to be incentivized are the lower income workers. Now, there are some lower income incentives as we speak, the Savers Credit. This would basically turn the Savers Credit on steroids because, well, let me get to it. What the Biden plan for older Americans is breaking into the middle of this paragraph, which I'm quoting directly from their white paper. The system of deductions and marginal tax bracket, all that. This provides upper income families with a much stronger tax break for saving and a limited benefit for middle class and other workers with lower earnings. The Biden plan will equalize benefits across the income scale so that low and middle income workers will also get a tax break when they put money away for retirement. Now, part of this will also get a tax break. Keep in mind, many workers, low income workers, don't pay any income tax. They pay payroll taxes, but they don't pay any income tax. And so again, part of the argument is these people get no tax incentive. We need to incentivize them, and we do that by turning the credit, giving it some steroids to beef it up. What the Biden or plan would do would be to eliminate the tax deferral, income tax deferral on contributions made to defined contribution plans. And this treatment would apply to both employer matching or profit sharing contributions as well as elective deferral type contributions, or for that matter, IRA contributions. And so that would raise, at least up front, billions upon billions of tax revenue. Ultimately, when the amounts come out of the plan, it appears the structure would be they would be taxed like after-tax employee voluntary contributions, which means as each as you withdraw each piece, the amount that was already taxed will not be taxed again. It'll be return of principal, if you will, but the investment earnings generated while the money sat in the trust will be taxed as it comes out. And so we take this enormous pool of money and we use that to fund a credit that would be given based upon how big a contribution is made to your defined contribution account. And this credit would not be per se a tax credit, but it would be taken and deposited in, contributed to the plan by the federal government, essentially as a government matching contribution. So the idea is, it's not entirely clear, but estimates seem to indicate that a revenue neutral, if you took all the money you just raised by doing away with deferral and use that to fund the cost of the credit, it would generate about a 26% credit. And so if our individual making $600,000 who made a $10,000 contribution would get a $2,600 credit contributed as a matching contribution to his or her account. The individual making $60,000 who made that same $10,000 contribution would get the very same $2,600 matching type contribution. Obviously, that's a diminution of the tax incentive for the wealthy. And keep in mind, what this whole argument fails to consider is that our tax code has built into it checks and balances to make sure that lower income employees, i.e. non-highly compensated employees, must benefit if the big kahunas, the highly compensated, are getting a benefit, whether it's the non-discrimination rules under 401A4, the 401K testing rules, the safe harbor rules, the top-heavy rules, the cap on compensation that must be considered. And yet, this is thrown out as, really righting that wrong. So I don't, this would be quite a big leap. I don't see that in this Congress with the centrists that are in place. I do expect something along these lines to be introduced in Congress for discussion. I mean, this was in soon-to-be President Biden's plan, and it's been promoted by a Urban's Brooking professor, Bill Hale, who a protege, I believe, I may be overstating it, but Ben Harris was the chief economic advisor to the Vice President Biden when he was vice president. He's on the Biden team of advisors today. He's tight with Bill Hale. Don't be surprised to see something like this, not in this Congress. And don't kill me for this. Let me just make one last point, then I'll take your question. Not in this Congress, but it's 2021 and we're about 19 months away from the midterm elections. Yes, I said it. But in the midterm elections, there are 34 every member of the House of Representatives is up for re-election. There are 34 senators, 14 of whom are Democrats, 20 of whom are Republicans. So the Republicans are defending more seats. I'm told 8 to 10 of those seats are competitive. So there could be changes. Who knows what's going to happen with the Republican Party after the events of the last few months. And so something like this could move forward if the Democratic majority is increased in the next Congress. I'll take a breath. Yes, Andrea.
A couple slides back, we had a question about the mandating of retirement plans, the requirement of having a retirement plan. Isn't California already adopting this through CalSavers, requiring companies to either join the California-sponsored state plan or starting their own plan?
Absolutely correct. That is true. And I believe Richie Neal's Richie Neal has not yet introduced the Automatic Retirement Plan Act. He didn't do anything in the last Congress, but in late November, he put out a, quote, discussion draft, which was tantamount to the same thing. And so he's expected to reintroduce it. He is exempting state programs that are already up and running from having to include this. And as I think I said, it's not that they're not the supportive of the state programs, but they want to take it a step further and make it all 50 states. So it's not just Oregon, and it's not just California. I think Washington State, there are variations in some of the other states. And so that's the idea. Yes, some states are doing it. They are not going to be opposed by the Biden administration. You know, that's a first step, and it's a question of whether they can find enough voices on the Republican side in Congress to get something like this enacted. Hope that was responsive. I gave this webinar earlier in the week, and there was one thing I should mention about the Biden proposal. Two things. One, it's only defined contribution plans, not defined benefit plans, as it has been proposed in a very, I guess I should look at the camera. I'm looking at my phone talking to you down there. It should be, the bottom line is that there is likely to be a lot of give and take in this upcoming Congress. I know I lost my train of thought and all that. I'm back to it. It's tough getting old, I tell you. I'm elderly under the vaccine rules, and so hope springs eternal. In any case, I digress. It accepts defined benefit plans, so you can still make DB contributions, which are exempt from tax. It also doesn't appear to address Roth contributions. And I, honest to God, saw an article today that said, well, everybody's going to move to Roth. Well, no, I don't think. I think they will plug those loopholes before we ever get there. But nevertheless, there are some loopholes. This is, kind of broad policy right now. Filling in the details is going to take a little more time. All right, we made it to Secure 2.0. Now, like I said, this was introduced in the last Congress, I think October 27th, if I'm not mistaken. Noteworthy, it's sponsored by both Richie Neal, the chairman of the Ways and Means, and Kevin Brady, the ranking member, both of whom will be returning to those slots in the new Congress. It is a comprehensive bill. Now, what I had heard, it would be marked up as early as February in the new Congress. And what a markup means is this bill will be formally heard in a full committee hearing of the Ways and Means Committee. Members of the Ways and Means Committee can offer amendments. Ultimately, the Ways and Means Committee will then vote on it as a whole and vote to send it for consideration on the House floor. That doesn't mean it goes immediately to the House floor. It'll be up to the Nancy Pelosi and House leadership to decide when they may take it up. But it'll be sitting there waiting for a vehicle, a train to which it, as the caboose, can hitch itself. And so, if you recall, that's how Secure, the last major pension bill, got enacted, by being attached to that 11th hour budget bill in 2019. So expect a new version to be reintroduced. It will have changes from the first version that I'm about to talk about. One of the issues with this bill is it doesn't have any pay-fors. What do I mean by that? I mean that this bill, as written, will lose a lot of tax revenue for the federal government. And depending on how it is considered by Congress, it's possible it might have to have offsetting provisions that raise taxes. At this moment, it doesn't. It hasn't even been scored by the Joint Committee on Taxation with their estimate of what that cost may be. So how it is ultimately, brought into play will depend upon the exact vehicle to which it's attached. If it's attached to a massive budget reconciliation, there may not be a need for a pay-for. So in any case, it is a work in progress, but I believe the major structure of the bill is as we see it today. So what would it do? It would mandate that every 401k, 403b, or simple type IRA plan or simple K plan would have to automatically enroll participants. It wouldn't mandate that you had to have a plan, but if you have one, it's got to have automatic enrollment. But it's on a going forward basis. If you have already are sponsoring on the date of enactment a K plan, 403b, or simple, you don't have to add automatic enrollment. But new plans going forward would have to have auto enrollment that begins at least 3%, goes no higher than 10%, and if you start lower, you've got to auto escalate 1% each year till you actually reach 10%. Small businesses of 10 or fewer employees would be accepted, as well as new businesses less than 3 years old, as well as church and governmental plans. Small business new plan startup credit. That was jacked up by the Secure Act from $500 to now it's 50% of the startup cost for a new plan up to a maximum of $5,000. And it's actually, it's prorated based upon the number of non-highlies covered by the plan. If you have 20, you get the full $5,000. You get it for the first 3 years of a new plan for a small business, i.e. that's less than 100, fewer than 100 employees. The new bill or the Secure 2.0 would increase that credit to 100% for the smallest of small employees, but employers, in this case 50. So up to 50 employees, you would be able to get a tax credit of 100% of the startup costs, up to a maximum of $5,000 for each year. So again, obviously the intention is to really focus on the smallest of small employers to encourage them to set up plans. So, workplace savings statistics show you're 15 times more likely to save there if you have a workplace savings than if you have to do it on your own. There would be an additional credit above and beyond the startup, the small plan, new plan startup credit. During those first 3 years, the government, if you will, would pay for, give you a tax credit for a portion of the employee contributions, up to a maximum of $1,000. So it'd be 100% in the first 2 years, 75, the third, 50, then 25. So it goes 5 years. And if you have between 51 and 100, there's a proration where the credit fades out when you're to zero when you reach 100 employees. Good thing. The startup credit would also clarify that when you join a multiple employer plan and are doing so to establish your first new plan, you would be entitled potentially to small employer new plan startup credit. This was part of Secure. That was probably a technical glitch that's being corrected. And in fact, Richie Neal includes this as part of his Democratic agenda for the Ways and Means Committee. It was, and the problem is that if you've got a MEP that's been around 3 years, then its first 3 years in which the small plan startup credit would be available have already passed. So this would reset the clock as each employer, new small employer joins. It would also allow for multiple employer 403B plans, and it would allow 403B9 type custodial account plans to invest in collective investment trusts. And CITs have been touted as a much less expensive investment alternative. Securities laws have precluded the 403B plans from being able to sponsor to use as an investment, a collective investment trust this would change that. I think would be welcomed by the 403B community. Required minimum distributions, RMDs. Secure moved up the age for starting them to 72. Secure 2.0 builds on that by allowing anybody who's got no more than $100,000 in retirement assets scattered amongst all their retirement plans. If in the aggregate, those in IRAs, they have less than 100,000, they do not have to begin RMDs, or if they've been taking them and it falls below 100, you don't have to take any more, or you can suspend them till it goes back above 100. And that 100K limit will be adjusted for future cost of living increases. Second RMD change is to move up even higher the beginning date from age 72 to age 75 for people turning 75 after December 31 or having a birth date in 48 that would make them 75 and 23, I guess it would be. The age 72 provision in the Secure Act was done because of the belief that we are all living longer and we shouldn't force people to start taking retirement savings earlier. We don't want them to outlive it. Let's move it back to 72. Great. It cost billions of dollars. I think that provision alone was either $800 million to $1 billion in foregone revenue. It was paid for by eliminating the stretch IRA, the ability of a beneficiary to stretch out IRA payments over his or her life expectancy. So there was a pay for to pay for this 1.5 year increase. There is no pay for to move it to age 3 years to age 75. This would cost a ton, but there's still a belief some way it should be done. It's just how to pay for it. And so if it ends up in a bill where there are no pay fors, it could go. But the another vehicle is that they extend the effective date. You know, normally when a tax bill goes through, it's got a 10-year budget window that you look over that 10-year period, how much revenue is lost. You can save a lot of lost revenue by putting a provision such as this into effect in the last year of that budget window, so that it is only 1 year of lost revenue rather than 10 as a result of people foregoing to take minimums from age 72 to age 73. So a lot of popular support. The problem is, how are you going to pay for it? 1042 exchanges. This is a provision in the tax code that allows a privately owned C corporation, the owners of that, to sell their stock to an ESOP and take the proceeds of that sale and roll it into qualified replacement property, which is principally marketable securities, and avoid continuing to defer the tax on the capital gain from selling your stock to the ESOP. What the bill does is allow subchapter S shareholders the same treatment. So good thing, who can complain about that? This is something, though, we probably can complain about. It would, the Secure Act gave us the mandate that we must cover long-term part-time employees. Long-term part-time employees are defined as an employee who has completed 3 consecutive 12-month periods in which they had at least 500 hours in each of them. If that person achieves that service, they must be eligible to make elective contributions to the 401k plan. This is only 401k, not 403b, which has universal availability, so that's why it's not there. In any case, it requires 3 periods of eligibility. The new law took effect January 1, 2 weeks ago. However, for eligibility purposes, it is permissible to exclude service credited before January 1, 2021. So under current law, the earliest, if you string it out, you don't have to, but if you string it out, the thinking is the person will come in no earlier than 1/1/24. We still need a lot of guidance from IRS as to exactly how that will work. In any case, what Secured 2.0 does is drop that 3 consecutive years to 2, and does it retroactively as if included in the Secure Act. So, I mean, we're looking at potentially having to deal with this new part-time employee rule a lot sooner than we thought. We're in the process of putting together a webinar on the long-term part-time employee rules. Probably be doing it sometime in the early spring, so be sure and keep an eye on our NOVA LinkedIn page for word of that, and I think you'll find it very helpful. And we'll certainly send an email out to those on our email list. What else? Student loan debt repayments. The bill would allow matching contributions to be made to a 401k plan that match the student loan debt repayments. There was a private letter ruling. Abbott Laboratories was doing this. That's fine, but under current law, that contribution is not considered a true matching contribution because it's not made with respect to an elective deferral contribution. What the Secure 2.0 would do is to change that into, allow it to be treated as a match, which we tested in the matching test, the actual contribution percentage test. Moving quickly. E-disclosure, as I mentioned, AARP and others have criticized these final regs that came out. They're worried about senior citizens not having internet access. I believe this provision in Secure 2.0 has their fingerprints all over it, but I do not know that for a fact, so this is just speculation. But what this would do is require at least once each calendar year one quarterly benefit statement that we're already giving out in our DC plans. Have noticed that you can elect paper notices if you'd like at any time, and going through basically the same type of information that is given under the DOL rules when you initially go to e-disclosure as the default method of disclosure. It's not that big a deal. We're already giving out the. What would make more sense is to make this a standalone type notice. Military spouses, there's a belief that military spouses are moving often because their spouse gets deployed to new locations. This would reward employers for allowing them to enter the plan after only 2 months with a $250 credit and another potential $250 credit toward employer contributions. This is also listed on the priorities for the for Richie Neal. Let me get to this. So this is important. Right now, people are fearful of auto enrollment and auto escalation because you're going to make a mistake, and if you make a mistake, you got to go through the IRS rules to correct it. Those IRS rules allow for very liberal and easy corrections if you fix an auto enrollment or an auto escalation error within 9.5 months after the close of the plan year, which is the due date of the Form 5500. Those IRS rules expired January 1st. What this would do would ensconce that rule into the Internal Revenue Code, not leaving it at the behest of the IRS. IRS would still need to issue implementing guidance. And I'm actually, as a sidebar, I'm hearing the IRS is going to extend the current rules, and that should be coming out soon. It would also direct, not put in the code, the IRS to extend the self-correction period basically indefinitely. It would also promulgate more safe harbor corrections, a number of things. Organizations such as ASPA, when I was there, things we were looking for. It would direct DOL, IRS, and PBGC to put together a report how to fix our ERISA notices. They have 18 months to do so. Don't hold your breath waiting on that. Make some changes to encourage more deferred annuities in retirement plans. Add some, if a plan makes an overpayment to a participant, FCRS, the IRS correction program, basically encourages you to collect that money from the employee who got too much. The IRS came in and said, well, you don't always have to do it, but if you don't, you have to make it up yourself, Mr. Employer. Many plans still go after the money. What this would do is put in a Bill of Rights, if you will, as to the process by which you could go after that overpayment and essentially put in a 3-year statute of limitations. This is silly. You can do a benchmark on your 404A5C, your chart of designated investment alternatives. If you've got a target date fund, you can't use a blended benchmark right now under DOL regs. This would let you do that. Would establish an office of for lost accounts. Basically, when you had a terminated participant with a deferred vested benefit, the information you already filed for that person with the IRS would be enhanced a little bit, but that would be used by PBGC to set up a database which would be searchable by participants to look for lost savings. Stay with me, folks. I know I'm getting the hook shortly. It increases some of the ability to make qualified charitable distributions. It provides for plan amendments basically a year to 2 years after, or the effective dates are a year to a second year after. Those will change without question because the bill is going to be reintroduced. We'll have a couple years to amend for it. Here's my take. This, as I've already made it clear, I think this has legs. It is likely to be married up with something coming from the Senate. Senator Portman and Cardin have introduced the legislation in the last Congress that 14 of the provisions in their legislation are largely identical to what was in the Senate bill. And so, being bipartisan legislation, we very well may see that. As far as Richie Neal, like I said, this is likely to be introduced. You would be required to have a plan if you don't already have one. If you've got a plan, any kind of 401A plan, could be a DB, could be a money purchase, could be a straight profit sharing, that would be sufficient. You would be grandfathered. Otherwise, you would be required to adopt a 401K or 403B or payroll deduction IRA program through which you would collect employee contributions. The employer would not be required to make any contributions. If they chose to do so, you would not have to take into account these employees who haven't completed a year of service. You could exclude union employees, non-resident aliens with no U.S. source income. There's sort of a convoluted rule for seasonal employees. The bottom line, again, the details of this bill remain to be seen. Richie Neal's put out a discussion draft, and by its very name, it's for discussion, meaning there may be changes once the discussion has been had. Expect him to introduce the Automatic Retirement Plan Act. Don't expect it to go anywhere anytime real soon, but it is indicative of where we're going. You folks have been most kind and understanding to me. I am 5 minutes past my time, and so I will give myself the hook and turn it back to Andrea.
Thank you. All right, well, we don't have any other questions, but we really do appreciate, first off, everyone taking time out of your day to attend. I know everybody's really busy with the beginning of year items for your companies and for advisors. So again, we really do appreciate that. I also want to mention again, there will be a pop-up survey afterwards that you will need to complete if you would like a CE certificate for either CSP, ASPA, or IRPA. Again, you do need to fill that out in order for us to know that you need a certificate for us to send that out to you within the next week. Also, this recording will be available on our NOVA YouTube channel. Just go to YouTube, search NOVA 401k Associates, double-click on our channel, and click all videos. This video, as well as several other webinars, will be available and are currently available on our YouTube channel. Also, please feel free to visit our website, www.nova401k.com, and see our other webinars that we are offering. Check back there every once in a while because oftentimes we will add new webinars throughout the year.
In fact, I should add, we are looking at one for mid to late February on some of the Secure Act guidance that has come out. So think about joining us for that. We'll have a better word on that in a week or two.
All right. Well, I think that's all we had. Craig, did you have anything else?
Only to wish everybody a very happy New Year. I should have done that at the start, but stay safe, everybody. You know, there's light at the end of the tunnel. It's not a train. I think we're going to get there, so stay safe till we get there. Otherwise, if anybody has any questions, reach out to me at NOVA. You can find my contact information on the NOVA website. Bye.
All right. Well, thanks again, and everybody have a great day.